Hey guys, welcome to PlexTalk. My name is Alan. I'm a sales director at plexcon Construction. This is Ribhu from BLD Financial. He specializes in multiplex lending solutions. We're going to walk through some common questions our clients have in these type of projects. So welcome, Ribhu.
Yeah, so BLD Financial or BLD Financial stands for Buildings, Land and Development. We specialize in all financing commercial with a specific focus on multifamily financing. So whether it be construction, bridge, acquisition loans, we do it all. We pride ourselves in being able to support, the small to mid-market investor as well in spaces where the banks don't even give them attention, and coming up with really creative solutions to help investors scale.
So we have a lot of clients that have questions about, construction loans and the CMHC programs in the multiplex space. You want to maybe talk about what CMHC is, what kind of programs are out there?
So CMHC financing has been, a hot topic lately. CMHC is a mortgage insurer, and what they've been offering on the multifamily front, so 5 units plus, is really attractive financing solutions for a few key reasons. One, they offer a much better interest rate than conventional financing. They offer longer amortizations. They offer lower debt servicing requirements, so you can get a bigger loan on the same asset. And specifically for construction, they'll fund up to 95% of the project cost, which is pretty unreal. So it's been a really good tool to spur the multifamily market. And we're seeing a lot of investors pivoting, a lot of developers using this product, especially in the last couple of years.
So you mentioned up to 95% for LTV. Is that typical, or is that pretty difficult to get for like a 5-plex or a 6-plex in Toronto?
So 95% loan to cost is not too difficult to get in a lot of cases. When you start to get into the loan to value approach on the purchase of existing buildings, it does get tougher to achieve in Toronto, specifically because of how the points are scored. Generally speaking, in order to get 95% loan to value, you need to commit to some sort of affordability, which people don't necessarily want to do in Toronto markets. We see people getting 95% loan to value in other markets, but in Toronto, 85 seems to be the standard. Now, if you were to get construction financing, you only really need energy efficiency points to qualify for 95% loan to cost. So we are seeing the loan to cost approach on construction a lot more often than on the acquisition.
How many programs are there in CMHC?
CMHC has a bunch of programs, with MLI Select being the hot topic right now. But MLI Select isn't the only game in town for CMHC. They also offer CMHC standard financing. The benefit of that is you still have the benefits of extended amortization and lower interest rates without having to commit to energy efficiency, affordability, or accessibility. People also don't know CMHC offers programs for student housing, retirement homes, and more. So CMHC does a lot in the game. It's just MLI Select has had the spotlight on it. I mean, for good reason, but there's a lot more to it.
Is there any pros and cons with going through MLI versus the standard program? Like, what's the major differences between the two?
Yeah, so the biggest difference between MLI Select and CMHC Standard is the fact that with CMHC Standard, a product, you don't need to score any points in any of the buckets for energy efficiency, affordability, and accessibility. Now, the downside is MLI Select, you can get up to 50-year amortization, you can get higher loan to value and a lot more aggressive financing terms, as well as MLI Select typically comes with less insurance premiums. However, last year, they did change the insurance premiums for MLI Select. So now the gap between the insurance premium between MLI Select and Standard have really shrunk. There are some developers and investors who have chosen now to start using CMHC Standard to get around the MLI Select process, not having to commit to energy efficiency, etc., especially for people who are buying existing multifamily assets. But I'd say generally speaking, people who are building brand new, they still opt for the MLI Select, primarily because of debt servicing and the whole 95% loan to cost piece.
So with CMHC, I mean, you need at least 5 units to qualify. If someone were to come to you and say they're doing, like a bigger project, 20 unit plus, would it still be going through MLI, or would it be a different program?
Whether it's 5 units or 20 units, we'd still be using the same CMHC financing product. Generally speaking, most people are opting for MLI Select. The key thing to understand, though, is as you get bigger, there could be additional requirements, such as bonding requirements for contractors, There may be additional requirements like a rental achievement holdback, where CMHC holds back a portion of their last draw on the construction financing until you're leased up. Now, not saying these are all necessarily going to be the case, but as you get bigger, there could be extra steps added, but it's the same financing product at the end of the day.
I guess the first conversation when you have with these clients, what would it be like? How would you walk them through the process?
The first conversation when we're assessing whether somebody is a good fit for qualifying for construction financing is typically revolving primarily around the personal net worth statement of that person. When it comes to construction financing, liquidity is key. A lot of these projects, they're very cash intensive. You need to be able to cover deposits. You need to be able to cover cash in between draws. You need to be able to get the land, etc., etc. Understanding the client's liquidity position is a big portion upfront. Now, this style of financing, your personal income and credit doesn't matter as much as it would on the residential side. So while it's part of a conversation, I'd say it's pretty secondary, especially on the first conversation. But personal net worth is a key part of that initial consult. Other important things when dealing with a construction project is the builder experience that you have on file. There's been numerous times where files have been canceled just because the builder has not been able to showcase enough experience. So really, that initial conversation is revolving around personal net worth, liquidity, builder experience, and then establishing that we have a good exit. So we're doing the CMHC underwriting upfront to make sure that you'll be able to exit the construction loan once completed.
When a client has a project in mind, should they be coming to you before or after they purchase the property?
So I'm involved with the clients even prior to them purchasing the property. It's really important that people's expectations line up with reality. So the most successful clients that I've worked with, we're doing feasibility analysis on what the financing plan would look like prior to them even buying the building. We need to make sure that the square footage of the lot can give them the rents that they want, and so on and so forth. So it's really important that we work with clients really upfront. There's been numerous times where people come to us mid-project where, unfortunately, we're not able to get them the financing that they want just because the math doesn't quite check out in the way that they'd hoped. So yeah, I'd love to get involved early on in the process to make sure things go as smoothly as possible.
Yes. So with the MLI Select program, they have a new energy efficiency scorecard for this year. Can you maybe walk us through how that affects a lot of the projects coming up this year?
So CMHC recently enacted changes in their point scoring system for energy efficiency. The requirement above building code has increased for new construction projects. Now, this is going to have a cost impact on all new construction projects across the board. The changes take effect at the end of September in 2026. So all CMHC applications submitted prior to this date will be exempt from the new rules. Everything after that, though, will be subject to the new rules. So we've been recommending clients who may be at risk of this to ensure that their building plans account for the new changes so they don't get stuck halfway through. Now, chatting with people in my network, such as plexcon, some of the direct impacts could be potential amperage upgrades where you previously didn't need it, but not in all cases. So it's going to be really important for clients to talk with their energy consultant, talk with their builders, talk with their architects, and really understand the cost impact that this is going to have on their individual projects. So the rule changes apply to new construction projects. I'd say there hasn't been much changes on existing CMHC applications. It really applies to new construction.
So there's a lot of mortgage brokers, lenders out there. What's the importance of a client using someone like yourself that specializes in these type of lending situations?
It's really important for clients to work with mortgage brokers who understand the end-to-end construction financing and CMHC takeout process. I've dealt with numerous clients who tried to buy the piece of land with conventional financing and then get construction financing after the fact and so on and so forth. And without the right plan from the start, that can get very, very expensive. There's been numerous mistakes that I've seen with clients trying to get extra funds midway through a project. Now, while this is all possible and we have lenders who will do it, there's quite a price tag that comes to it. We've seen people pay tons of extra fees just because they didn't go in with the right plan from the start. $40,000, $50,000 in fees across the cycle of a project is a lot of money.
Doing a multiplex project, there's a lot of risk and complications that could happen. Maybe you can walk through how to smooth out the process and reduce these risks?
Cash and access to liquidity is king when it comes to construction projects. And having that real conversation up front about what your cash plan is very, very important. There's two things. One, the required equity to get construction financing, and then what we like to suggest you have for equity for financing. Going into a project, there's factors such as construction lien holdback, HST requirements, things, extra cash requirements, builder deposits that people don't necessarily factor into their whole cash flow plan. It's really important that you sit with your mortgage broker at the start to ensure you have the right cash plan getting into the project. That might mean putting on a home line of credit on one of your other properties. It might mean refinancing something else. But having that will save you so much stress during the project that I can't stress it enough.
That makes a lot of sense because I think me and you both had a lot of situations, a lot of clients, some mutual clients, where they didn't have the planning, I guess the planning in place from the start, and we went through quite a bit of complications during the process, and it could have gotten a lot smoother if the planning was in place. If someone like, if the client spoke to Ribhu from the start, we could avoid a lot of problems from the start. Yeah.
It gets really expensive to get extra construction financing midway through a project, especially if you don't have proper accounts, if you've been paying things in cash. I always recommend get the money you need up front because it's a lot easier to get up front than midway through.
With the current market right now, do you see any concerns in the market for our clients?
The two biggest risks that I think clients should consider when they're getting into these projects is the potential of rent compression in the next year or two, as well as the volatility that we're seeing in the mortgage markets right now. A lot of experts are predicting that rents in Toronto may decline. And while this doesn't mean you're going to be negative equity in your project, you're still generating a ton of equity by doing this. You may potentially leave more cash in the deal than you had planned. So it's important to understand that, to know what your worst case scenario is when you are doing your underwriting. The second point around mortgage market vulnerability, with the whole state of the world right now, the war and so many other factors, there's been a lot of volatility in bond yields, specifically the Canada mortgage bond. Now, that directly impacts your CMHC takeout financing rate. So it's important to understand how the market is moving at a macro level to feed into your exit underwriting. Typically on all deals, when we underwrite for clients, we are underwriting a best case, base case, and a worst case scenario. So just understanding what your three potential realities are is very important before jumping into one of these type of projects.
So a lot of first-time investors, they might have a lot of questions on how to start a project, how to get financing. Is financing for these type of projects very different from a regular residential mortgage?
Yeah, so the steps of going through a construction loan process is pretty straightforward, but very different from different other types of financing. So typically, it starts with the land acquisition. People either buy the land or property with a house on it in cash or with some sort of mortgage on it, and make sure we need to make sure we structure it right from the start. And then as permits, drawings, budget, and everything is hashed out, we go for the application of the construction loan. This could be a CMHC construction loan, a private capital firm construction loan if it's a smaller project, a credit union construction loan. Whatever it might be, the process is very similar. Once we have drawings, budget, and everything in place, we get an as-is and as-complete appraisal. The as-complete appraisal will dictate what the value is going to be at the end of the project, but it'll also have a matrix which will break down the cost at each stage of the project. So foundation, let's say, is 15% of the project cost, and so on and so forth. Now, this becomes a guide for every future draw. On larger projects, you may need to get a quantity surveyor involved or some other inspector, but the mechanism is the same. As you progress through the process, you get construction draws, and your construction loan is slowly divvied out as your project progresses. Now, if you did some sort of conventional construction loan to start, so private, credit union, and so on, and you're taking CMHC at the back end, doing a CMHC takeout loan, we typically start the whole process with CMHC a couple months before completion because we can submit on new construction projects using an as-complete value. And as you may have heard, CMHC could potentially take a long time to process applications. Now, it's very important to understand that if we submit an application with an as-complete appraisal, the expectation is we need to hit those rents that are in the appraisal. So it's important to go into a CMHC application with realistic rent and realistic assumptions, because if you don't hit that, it could potentially affect the loan that you're going to get on closing. Yeah. So if you don't hit your effective gross income targets, there could be an insurance premium impact because they'll define your loan as EGI not met. And there can also be a loan reduction as a result of you not meeting the debt service requirements anymore. It's really important that when we submit for a CMHC application, especially using an as complete appraisal and fair market rents, that we're using conservative numbers.